The bank is not your friend. This is not a cynical statement. It's a structural one. The bank is a business with shareholders, quarterly earnings targets, and a product suite calibrated to extract maximum value from the specific category of customer who needs the bank more than the bank needs them. The checking account that charges you to hold your own money. The savings account paying 0.01% while lending your deposits at 7%. The overdraft fee on the $6 transaction, the wire transfer fee, the foreign transaction fee, the minimum balance requirement that punishes you for not having enough money to avoid being punished. None of this is malicious. It's rational from the institution's perspective. They charge what the market allows. The market allows it because most customers have no alternative. The customer without options is the customer who pays every fee on the published schedule, accepts every rate in the standard brochure, and generates the reliable margin that funds the quarterly earnings report. The customer with $30,000 outside the bank is a different customer, not because the bank treats them differently, though it does, because they are structurally different. The $30,000 positioned correctly outside traditional banking isn't just savings. It's a competing financial infrastructure that does what the bank does better in most of the categories that matter, while simultaneously changing the power dynamic every time the customer interacts with the bank for the services the bank cannot be replaced for. Here is what actually happens when $30,000 sits in the right places outside the bank. Not what feels different, what structurally, mechanically, documentably changes. Let's start with the yield. Because the yield gap between conventional banking and the alternatives available to someone with $30,000 positioned correctly is large enough that it deserves to be called what it is: a tax on not knowing better. The national average interest rate on a traditional bank savings account in 2026 sits between 0.40 and 0.60% annually. The national average checking account pays approximately zero. On $30,000 held in these accounts, the annual interest earned is approximately $120 to $180. 12 months of patience for $150 in return on $30,000 in capital. The alternatives available to someone with $30,000 who understands where to position it produce dramatically different numbers. High-yield savings accounts at online banks and credit unions in the 2025 to 2026 rate environment pay between 4.0 and 5.2% annually. On $30,000, that's $1,200 to $1,560 per year. 8 to 10 times the traditional bank yield from an account that is FDIC insured to the same $250,000 limit, equally liquid, equally accessible, and requiring nothing more than the one-time action of opening the account and transferring the funds. Treasury bills. The short-term debt obligations of the United States government, backed by the full faith and credit of the federal government, yield between 4.2 and 5.0% in the current rate environment for 4-week to 26-week maturities. They are accessible through treasurydirect.gov with no minimum purchase above $100 and no fee. They are not FDIC insured because they don't need to be. They carry the explicit backing of the U.S. government, which is the entity that backs the FDIC. And they carry a specific tax advantage that high-yield savings accounts don't. Treasury interest is exempt from state income tax, which in high-tax states like California, New York, and Illinois can add 0.5 to 1.3% to the effective after-tax yield. On $30,000 in Treasury bills in California in 2026, the after-tax yield advantage over a traditional bank savings account is approximately $1,200 to $1,500 annually. Not from a risky investment, from the obligation of the federal government held in an account with no fees. Money market funds at major brokerages, Fidelity, Vanguard, Schwab, hold portfolios of Treasury bills and other short-term government and agency securities, yielding between 4.2 and 5.0% in the current environment, with daily liquidity, no minimums in most cases, and the full regulatory framework of a registered investment fund. The $1 net asset value convention makes them functionally equivalent to cash for practical purposes, while generating yield that the traditional bank savings account cannot approach. A money market fund at Fidelity holds SPAXX or FZFXX, depending on the account type, and generates yield daily that compounds into the fund balance automatically. No action required. No laddering required, no maturity management required. The $30,000 sits in the fund, earns the current yield, and remains available for next-day transfer to wherever it needs to go. The combined annual yield advantage of the correctly positioned $30,000 held across a split of high-yield savings and Treasury money market funds over the same $30,000 held in traditional bank savings is approximately $1,100 to $1,400 per year. In 10 years, that annual differential, reinvested at the same yield, compounds to approximately $15,000 to $20,000 in additional wealth from the same $30,000 doing nothing except sitting in a different location. This is the first thing that happens when $30,000 sits outside the bank correctly. It earns money that the bank was previously keeping for itself by paying you a fraction of what it was earning on your deposits. And here's where it gets really weird. The traditional bank paying you 0.50% is lending your deposits at 7 to 9% on auto loans, 6 to 8% on mortgages, and 21 to 23% on credit card balances. The spread between what they pay you for your capital and what they charge others to use it is their entire business model. The $30,000 in a traditional savings account is capital you've donated to the bank's spread at a yield that doesn't remotely reflect what the capital is worth in the current lending environment. The correctly positioned alternative captures a yield closer to the actual value of short-term capital without requiring you to take on the lending risk the bank takes on its behalf. The second thing that happens is FDIC exposure management, which is a topic that most people don't encounter until they have enough money that it matters and then discover they never thought about it. FDIC insurance covers deposits up to $250,000 per depositor per institution per account ownership category. A single depositor with a checking account and a savings account at the same bank has $250,000 in combined coverage for those accounts in the same ownership category, not $250,000 per account. The depositor with $30,000 at a single bank is well within coverage. The depositor with $400,000 at a single bank has $150,000 above the coverage limit, which becomes relevant if that bank fails. Bank failures are not theoretical. The FDIC resolved 565 bank failures between 2008 and 2015. Silicon Valley Bank's 2023 failure was the second largest in U.S. history. The depositors at SVB who held more than $250,000 in a single ownership category at a single institution spent several days in genuine uncertainty about the recovery of the uninsured portion before the FDIC and Treasury intervened to make all depositors whole in that specific case. An intervention that is not guaranteed to occur in every future failure. The $30,000 position is not at FDIC risk at a single institution, but the $30,000 positioned across a high-yield savings account, a Treasury money market fund, and a brokerage cash account is protected by multiple coverage frameworks simultaneously. The high-yield savings account carries FDIC coverage. The Treasury money market fund holds government obligations that don't require FDIC coverage because the underlying assets are government-issued. The brokerage account carries SIPC coverage up to $500,000 for securities accounts. The diversification of coverage frameworks is itself a form of risk management that the single bank depositor doesn't have. The third thing that happens is the banking relationship power shift, but that begins meaningfully at $30,000. The customer who holds $30,000 across accounts at a single bank has a relationship with documented, quantifiable deposit value. When this customer contacts the bank with a service issue, a fee dispute, or a product inquiry, the bank's systems show a customer worth retaining. The retention value of a $30,000 deposit relationship, calculated by the bank's customer lifetime value model, is meaningfully higher than the retention value of a $3,000 deposit relationship. This doesn't mean the bank will do anything you ask. It means the bank's representatives will escalate your requests differently, apply their retention policies more generously, and offer products and rates that don't appear in the standard public-facing rate sheet. The rate negotiation on a mortgage, the waiver of an origination fee on a personal loan, the upgrade to a checking account tier that provides benefits without the listed monthly fee. These conversations happen at the $30,000 deposit relationship level in ways they don't happen at the $3,000 level. More significantly, the $30,000 positioned outside the bank gives you a credible alternative that the bank's retention model has to compete with. The customer who can demonstrate that they have $30,000 earning 4.8% in a Treasury money market fund is a customer who has already demonstrated the ability and willingness to use alternatives to traditional banking. This is qualitatively different negotiating leverage than the customer who says they're considering moving their money but hasn't actually done it. The demonstrated alternative is the leverage. The documented yield is the evidence. The conversation that follows is the bank explaining why their product is competitive with the alternative the customer is already using, rather than the customer hoping the bank will offer something better than the standard rate. The fourth thing that happens is investment account access that doesn't exist within traditional banking. When $30,000 sits in a brokerage account in a money market fund, it sits adjacent to every investment product available through that brokerage. Index funds, ETFs, individual securities, Treasury bills purchased directly through the brokerage without the Treasury Direct interface. Bond funds, REITs. The full range of investment products available to retail investors exists one transaction away from the $30,000 in money market funds. This adjacency is not the same as being invested. The $30,000 in money market funds is not at equity risk, but it is positioned for immediate deployment into equities when the investment decision is made, without a transfer timeline from a bank account, without a waiting period for funds to settle, without the friction that occurs when investment capital and banking capital are held at separate institutions with transfer delays between them. The investment decision, when it arrives, requires execution. The capital adjacent to the investment platform executes immediately. The capital in a traditional savings account at a different institution from the brokerage takes 1 to 3 business days to transfer and settle before it can be deployed. The market condition that prompted the investment decision may have changed during that window. This is a subtle advantage that becomes concrete in specific market situations. The significant market decline that creates a buying opportunity, the initial public offering with a time-sensitive subscription window, the treasury auction with a specific closing time, any situation where investment capital needs to be available at the moment the decision is made rather than several business days after the decision is made. The $30,000 outside the bank positioned in a brokerage money market fund is investment ready in a way that the same $30,000 in a traditional bank savings account is not. The fifth thing that happens involves taxes, specifically the interaction between where the $30,000 is held and how the income it generates is taxed. Traditional savings account interest is taxed as ordinary income at the federal level and the state level in most states. The full yield, whatever the bank pays, is ordinary income. Treasury interest is taxed at the federal level as ordinary income but is specifically exempt from state income tax under federal law. In a state with a 9.3% marginal income tax rate, a $30,000 position earning 4.7% in Treasury bills generates $1,410 in interest, of which the $131 in state tax is saved compared to an equivalent yield in a fully taxable account. The after-tax yield on Treasuries exceeds the after-tax yield on an equivalent nominal yield from a bank savings account in every state with an income tax. For investors in higher federal brackets, the tax equivalent yield of municipal money market funds, which hold obligations of state and local governments that generate income exempt from both federal and often state income taxes, may exceed the after-tax yield of Treasury money market funds. A household in the 24% federal bracket and 6% state bracket comparing a 4.2% Treasury money market fund to a 3.1% municipal money market fund finds the after-tax yields approximately equivalent. The portfolio construction that maximizes after-tax yield depends on the specific bracket, the specific state tax rate, and the specific products available, but the optimization opportunity exists and is not captured by the household holding $30,000 in a traditional bank savings account. The sixth thing that happens is the most personal and the most difficult to quantify, which is why most financial content either skips it or handles it with the vague language of peace of mind that doesn't capture what's actually occurring. The $30,000 positioned outside the bank changes the relationship with the bank from dependence to optionality. Dependence means the bank's terms, fees, rates, and service quality are constraints you accommodate because you have no meaningful alternative. Optionality means the bank's terms, fees, rates, and service quality are inputs you evaluate against alternatives you're already using, and the evaluation produces either continued engagement on your terms or a migration decision that the bank would prefer to prevent. The psychological experience of these two relationships is entirely different, not subtly different, categorically different in the specific way that changes how every interaction with a financial institution feels and, as a result, how every decision involving a financial institution gets made. The person in the dependence relationship makes financial decisions under the quiet pressure of constrained alternatives. They accept terms they know are suboptimal, because the alternative requires more complexity than the pressure of the moment allows. They don't dispute the fee because disputing it feels like confrontation with an institution that holds leverage. They don't shop the rate because shopping requires time and confidence and the belief that the effort will produce a different outcome. The person in the optionality relationship makes decisions with the calm of someone who has already done the comparative analysis and knows the result. They dispute the fee because they know what the fee costs and they know the bank has incentive to waive it. They negotiate the rate because they have a documented alternative to reference. They make the decision that serves their outcome rather than the decision that minimizes friction with the institution, because the institution's leverage over them is diminished by the demonstrated availability of alternatives. This psychological shift from dependence to optionality is real, and it is worth building toward with the same deliberateness as any other financial milestone. Not because it feels good, though it does. Because it produces better financial decisions across every category of interaction with the financial system, and better financial decisions compound over time in the same direction as better investments. Now let's address the question that the title deliberately leaves unresolved. What does outside the bank actually mean, and where specifically should the $30,000 be positioned to produce all 6 of the effects described above? The answer is a specific distribution across 3 locations that are available to any American with a Social Security number and a few hours of account setup time. The first location is a high-yield savings account at an online bank or credit union. Recommended institutions in 2026 include Ally, Marcus by Goldman Sachs, Synchrony, and several credit union alternatives with competitive rates. The high-yield savings account should hold the liquid, immediately accessible portion of the $30,000. Approximately $10,000 to $12,000 for a median income household, representing the emergency fund component that needs to be available for immediate withdrawal without any transaction or settlement delay. This position earns 4.0 to 5.0% annually, is FDIC insured, and functions identically to a traditional savings account in every dimension except yield. The second location is a Treasury money market fund within a brokerage account at Fidelity, Vanguard, or Schwab. The remaining $15,000 to $18,000 sits in this fund, earns 4.2 to 5.0%, remains available for next-day transfer, and positions the capital adjacent to the full range of investment products available through the brokerage. When the investment decision is made, the money market fund is the staging position. Until the investment decision is made, it earns a competitive yield with partial state tax advantage. The third location for households in higher state tax brackets is a small allocation to a Treasury bond ladder or a direct treasurydirect.gov account, holding 4-week or 13-week Treasury bills purchased directly at auction. This position earns the Treasury yield directly, captures the full state tax exemption without the fund expense ratio, and requires slightly more active management than the money market fund in exchange for the marginal additional yield and tax efficiency. The total position, $10,000 to $12,000 in high-yield savings at an online bank, $15,000 to $18,000 in a Treasury money market fund at a brokerage, 2 account relationships, 2 account setup sessions, 1 afternoon of paperwork. Annual yield on $30,000, approximately $1,300 to $1,500. Yield advantage over traditional banking on the same $30,000, approximately $1,100 to $1,300 per year. The ongoing management requirement, 0. Check the yield quarterly to confirm it remains competitive. Adjust the distribution if a rate environment change significantly shifts the relative advantage of one location over another. Otherwise, the position runs. And here's where it gets really weird one final time. The $30,000 outside the bank doesn't just earn more than the $30,000 inside the bank, it costs the bank revenue. Every dollar you move from a traditional savings account earning 0.50% to a money market fund, earning 4.8% is a dollar. The bank can no longer lend at 7 to 9% while paying you 0.50%. The bank that was capturing a 6.5 to 8.5% spread on your deposit loses that spread when you move the deposit. The revenue that was being extracted from your financial inertia by the bank is recovered in the form of yield by the decision to stop being inert. Financial inertia is expensive, not dramatically, not in a way that produces a single large identifiable cost, but consistently, year after year, in the form of yield foregone on the capital you worked to accumulate, paid in the spread between what you earn and what the institution earns on your behalf. The $30,000 outside the bank is the specific, concrete, immediately executable decision to stop paying that spread. Not a sacrifice. Not a complex strategy. A single afternoon of account setup that earns $1,100 to $1,300 more per year than the alternative on the same $30,000 doing nothing except sitting in a different location. The bank is not your friend. The bank is a service provider with products of varying utility. Use the useful ones, move the rest. The next piece goes into the exact comparison of every high-yield savings account, Treasury money market fund, and direct Treasury bill option available in 2026, with the specific after-tax yield calculation for 5 different state tax situations, so the positioning decision is made with complete information rather than a general framework. The numbers vary enough by state that the optimal distribution is different in California than in Texas, and the difference is worth knowing before the account setup session. The session takes one afternoon. The yield advantage runs for as long as the $30,000 exists. Set it up.